I'm actually kind of a bull. I think a trade above, what's the big figure, 59? Where are we at now, like 58, 70? A trade above 59, a settlement there, to me technically looks good to green light the next move forward.
So things aren't perfect out there, but services remain strong. There are parts of the economy that are still pretty darn solid. It's not perfect. You can have a bear market without a recession. We saw that in 1987. We saw that in 22, obviously. All the parts of the economy were there.
Gold and equities going up together. People have this false belief that gold is an inflation hedge. It's only an inflation hedge when the Fed is not fighting gold inflation. When the Fed starts fighting inflation, the option to gold, which is higher yields, becomes a viable thing. Inflation drives asset inflation too, which means stocks, homes, gold.
When you have higher productivity, you can cut interest rates. Maybe a good deal. You're going to flip-flop. So you're still going to have this divided Congress. Last 13 years, we've had a divided Congress. What happened? Stock market was higher. This is going to be the 14th year unless we have some really bad stuff take place here.
Welcome to the Futures Edge Show. I am Jim Muriel. That's Bob Iacchino. Today we have a special guest from Carson Research, head of market research, head of technical analysis, head of everything, right? Ryan Detrick, good friend of ours. Brian, before we get started, I want you to tell people where they can find you.
Yeah, first off, thank you for having me back, guys. There's plenty to talk about today, but I am out there. So I am the chief market strategist at the Carson Group, or a RIA. We're in 42 states. We're about to crack $40 billion total AUM. My team manages about $3 billion of that. CarsonGroup.com/research is our blog. Of course, I'm active on Twitter at Ryan Detrick. I'm on LinkedIn also. And then my weekly podcast called Facts versus Feelings. I do with Sonu Varghese on our team. That's a popular one as well. And it feels like you turn TV on. It feels like they've got my ugly mug up there a lot too. So you never know.
I do. I see it all the time. I turn down the light just so I can hear your voice. If that's,
there you go.
I mean, before we get started, I want to thank our sponsors, Hardcore Italians. Please go to the link that we provide. It's not just for Italians too. We're getting closer to Christmas. They have some really funny and interesting things that will be perfect gifts for an Italian near you. Also, thank you guys for the support on this. As you guys have seen, it is growing exponentially, and it has been for a year, and we owe that to you guys. Please like and subscribe, particularly if you are slanted towards smaller independent journalism that is not bending at the whims of overzealous producers or sponsors. That's what Bobby and I do. As I've said a million times, you may think our opinions are bullshit and disagree with us, but they are our honest opinions that are not being clouded by anyone else. And thank you. And it's because of you guys we do it, and because of you guys we're successful. Anyway, Ryan, I noticed in your Twitter bio, you mentioned barbecue. So this is something that's near and dear to me. Do you smoke meat yourself, or are you just looking for the perfect place to get barbecue?
Yeah, I would say I smoke a couple times a year. I do have a Traeger, so, but at the end of the day, I guess I'm more of a searcher for the perfect barbecue. I do not make the perfect barbecue, but I'm a fan, that's for sure.
Yeah, on Saturday night, my wife was gone for the weekend with her college friends. And on Saturday night, I get home, I work at my bar, but I'm really just drinking at my bar. So I sit down on my couch. I'm half in the bag. I'm about to fall asleep. And I just get a text from my wife going, "You remember to put the brisket on the smoker, right, for dinner tomorrow?" And it's 9:00 at night on Saturday. And I like to go all night with him. I'm like, oh, shit. So for the next hour, Drunken Jim is in his backyard, just cleaning out the smoker, loading the one in. It was terrible. Came out good, though. Oh, and don't tell her that, because I said immediately, of course I put it on.
Yeah.
You're right.
Well, let's hope she doesn't listen. Let's hope she doesn't listen to us.
She would never listen to me.
Yeah, it's
Ryan,
the same as me.
I
do a podcast all the time. I talk about all types of stuff. My wife has no idea what I'm talking about. So yeah, we're similar there.
Ryan, tell me about the Traeger, would you? Like your experience with the Traeger, because and for both of you, really, I'm looking for a smoker, but I'm looking for more of a combination. I do a lot of flat top grill stuff, but I have a flat top grill that goes on my range in the house. It's a big one. It covers the whole range, right? You heat it from underneath. You use the infrared scanner to check the temperature. And man, we kill smash burgers on that thing. Bacon and eggs on that is way better than in a pan. I don't care what anybody says, but it stinks up the house. So now I'm thinking, okay, I could build an entire outdoor kitchen, but I don't want to be more of a douche than I already am. So maybe if I could just get a nice smoker, combo barbecue smoker. Tell me what you guys know about this thing. Ryan, you've talked to a lot of people about it, I'm assuming.
Yeah, so I got my Traeger, I think 3 years ago, or maybe it was 2 years ago. I think about 3 years ago. And it's just kind of the lazy man's way, if you will. Because again, I don't want to spend all day. I've got buddies. I live down in Charlotte. They spend all day, taking the temperature and all that. This is like you plug it in, you control the whole thing from your phone. As long as I'm in the continental United States, get Wi-Fi or get my network, I can see what's going on. So from that point of view, you can say, hey, I made some ribs or I made a pork butt or whatever it is. You kind of cheated, again, lazy man's way. So I like it from that point of view. I've got some friends who, again, are more hardcore into this stuff. And once they see mine, they're like, wow, that is
that's why I don't want to see
most of the work for you,
Mine, of course, I live in Palatine, Illinois, which is the home of one of the great blue blood American companies. Do you guys know what it is? Trivia. Weber Grill, located in every Weber Grill that you've ever owned says on it, Palatine, Illinois. So I use a Weber mostly because it was only like $300 as opposed to $1,200 for the Traeger. I have the medium-sized smoker, so you need it. It's shaped like a bullet. It's like 4 feet tall, and you put a big pan of water in it because you want the smoke to come around the water, but the temperature to stay relatively constant.
It's hands-on.
What's that?
It's more hands-on.
Oh, much more hands-on. Like when
I want to be in a different city saying I'm smoking.
You can't do that. Like when I got finished at 10 o'clock, I went to bed, and then I was up at 5:30 in the morning to add some more charcoal in on Sunday morning to make sure the brisket came out good, which, by the way, it did. And the temperature, it's harder. It's more variable on those. But I always figure if I'm at 200 all night long, fine. I can jack it up to 220 in the morning for the next 5 hours and see how it works. But anyway, thank you for joining us for Meat Talk. I'm Jim Uriel. That is Ryan Detrick. All of us like food quite a bit.
Guilty.
There's some market stuff going on. Maybe we should talk about. Let's start with the S&Ps too, because by the way, Ryan, for the time I've known him, which has been years now, every time I think all hell's about to break loose, that the sky is falling in, I turn on Ryan Detrick, and Ryan Detrick basically looks me in the eye and say, fucking lax, right? Because we're fine, and you have always been right. Right now, I'm actually kind of a bull. I think a trade above, what's the big figure, 59? Where are we at now? Like 58, 70. A trade above 59, a settlement there, to me, technically looks good to green light the next move forward. What are you thinking?
Well, thank you for that. I mean, we at the Carson Group went overweight equities December of 22, and I've come on with you guys multiple times over that time frame. We got some weird looks saying we were optimistic, this time 18 months ago, 2 years ago, but we're still in that camp. The reality here, Jimmy, is November is November, okay? November's higher 11 of the last 12 years. The worst November we've seen in like 15 years was a 1% drop way back in like 2008, okay? Wow. I mean, you got to go, so it's just rare, or the last time we had more than a 1% drop, was back in 2008. That's just one data point. I get it. But, it's like, ooh, that's interesting. And then, of course, the election's coming and this and that. And someone who manages money, and we talk to a lot of shops that manage a lot of money. I mean, it is really true. So many people have missed this rally. There truly is, I know it's cliche to say cash on the sidelines, but there really is a lot, and people are kind of waiting for the uncertainty of the election, and we wouldn't be shocked at all if we continue to have kind of this upward bias, if you will. One final thing here, because I love to look at these numbers and what's history tell us. S&P's up 5 months in a row. It might be up 6 months in a row in a couple of days once we get through October. But after a 5-month win streak like we've just already had, S&P's higher a year later 28 out of 29 times. I mean, that's just, again, just one data point. When you stack all these on top of each other, we've been overweight for a while. We are still in that camp.
So, Ryan, we are the only industry that I'm aware of who has to say past performance is not indicative of future results, but check out the past performance. Mm-hmm. Right. And I always bring this story up. I had a roofer work on my house, not the house I'm in now, but in Chicago. And it was recommended by 2 neighbors, and he did a terrible job because he showed up to my house drunk. So the roofer's past performance was not an indicator of the future results.
Yeah.
So is that something that we still need to get people to understand? I call you Mr. Brightside for the same reason of what Jim just described, right? If I ever think, the sky is absolutely falling, let me open up Ryan's Twitter. right? And see what actually is happening versus the sky actually falling.
Yeah.
So why is it that we have to say that? I mean, why do you think that is?
Well, first things first, was you said it was a roofer who showed up drunk? Was that
It was
what
a
it was?
roofer.
Was he hanging out with Jim cooking brisket the night before? I mean, was that the,
That'll get you
He was
drunk.
at my bar. By the way, all the
I
tradesmen
can
do
vouch
hang
for
out at
that.
my bar. I was with them. Yeah.
I
There
can
you
vouch
go,
for
there
that.
you
That
go.
can get you drunk.
That's a great point. I mean, someone who manages real money, right, with real
Right.
clients. I mean, we have that disclaimer that we have to have on the bottom of everything. And I mean, listen, I've used the joke before. Well, if you had future data and future price action, I would use that. But unfortunately, I have been yet to find that. And that's a great point. I mean, I like to look at the past for a potential path where we're going, right? Mark Twain, history doesn't repeat itself, but it often rhymes. There's a lot of other forward-looking mechanisms. I mentioned his name already, Sonu Varghese. He's our chief global strategist is his title, macro strategist, his title. I mean, he looks at a lot of the macro data, what's happening right now with the economy. And the economy continues to surprise to the upside. So we kind of mold the two. I'm kind of known for looking at the past, but there are some more forward-looking things we look at. I mean, you just look at what we've seen just this earnings season. Get all choked up talking about earnings. We've once again had companies coming in better than expected. You've got a consumer that continues to surprise the upside. It's not perfect. Housing is a pretty legit concern of ours. As interest rates stay higher, mortgages are higher. Housing took away from GDP like 10 or 11 quarters in a row, added a couple times, and now it's starting to take away again. So things aren't perfect out there, but services remain strong. There just are parts of the economy that are still pretty darn solid. And again, that means if you don't have a recession, what tends to happen? Well, you tend to usually get, pretty good market returns. It's not perfect. You can have a bear market without a recession. We saw that in 1987. We saw that in 22, obviously. Other parts of the economy were there. What's fascinating to me, one final thing, we had two bear markets, okay, in the last 5 years, right? 2020 and 2022. Usually you don't have bear markets quite that close to each other. So we had a lot of pain. We all had a lot of pain. Everything is so easy because we had 47 all-time highs this year, a bunch of all-time highs last year. But the reality, again, is no, it hasn't really been that easy, okay? I mean, actually no all-time highs last year. It's 47 this year. We went almost 2 years without any all-time highs on the S&P. People forget that. And now we're starting to get going again. So listen, after 10 of 11 months, the S&P is higher, maybe going to be 11 of 12 here in a couple of days. That is awfully long in the tooth. We're aware of that, but the reality again is you get these blasts of strength, blasts of outperformance, and history would tell us you might have stronger performance going forward. That's the camp we're in, and then the macro backdrop continues to be, in our view, pretty positive. And we've been saying last thing. I know I keep saying last thing. Everyone's saying it was soft landing. We've been saying for a year and a half the plane had plenty of fuel. There's no need for any landing. We're still kind of using that lingo.
So that's where I wanted to go, and you actually introduced it perfectly. So given everything you've said, like the one soft spot to me is when I look at manufacturing. Mm-hmm. With manufacturing PMIs contracting, although maybe bottoming, right? We're still in contraction territory. Last PMI, at least the small to medium-sized business, what we all used to know as the S&P Global PMIs, look like they might be bottoming, though still in contraction in some countries. When I look at that as one of the last sort of things that needs to turn back up before it's just full steam ahead for the economy, why 50 basis points? Mm-hmm. Like, why is the Fed
call on me afterwards?
I will call on, I know Jim, but I want to give him the opportunity to say why. Why do you guys at Carson Group think they're doing that? Or do you just say, we don't care, they're doing it, so stay long?
Yeah, so a couple of questions. Let me unpack some of this. I mean, you mentioned the PMIs, right?
Yeah.
That's soft data. I mean, that's a survey of purchasing managers. Hey, how do you feel? What are you doing? That's one side of it. We've had the yield curves. We've had the LEIs. We've had M2. We've had a lot of these, GDI, gross domestic income. A lot of these things have been in the past, this led to a recession, and people use those for a long time. And obviously we didn't see a recession. We've been pushing back on the soft data. We look at it. I'm not saying we ignore it, but if you look at like hard data, manufacturing output over the past 12 months, it's like up 1.5%. I'm not saying that's spectacular, but I am saying there's been manufacturing output. Because if you look at these soft data surveys that have been sub 45, right? The PMI was sub 45 a while ago, but I said, every 5 times that's happened, a recession was like imminent. And obviously it didn't happen because you've got this difference. And we see it. I mean, I know consumer confidence today jumped pretty good. I get it. But even then, I mean, for stock market to be hitting all-time highs of 20% 2 years in a row, consumer confidence is really, really low, all things considered. And again, that's that. Yeah, but yet retail sales are strong and people are out spending and people are going to Europe. I mean, you're seeing these two different things. And again, the hard data, I guess, at least with manufacturing is not great. Let me be very clear, but it's 13% of our economy, right? Services is a lot more. And that's kind of the world that we're in. We are more of a services-based economy than a manufacturing. Now, to inflation, we were of the camp that the Fed did 50 last time, right? We get it. We were in the camp they probably should have done 25 the time before, then maybe 25 this time. But we do not think you need interest rates over 5% right now. We've been saying this for a while because the other lingo we use is inflation is last year's problem. I know what the headline numbers are, but if you use real-time shelter and rent data, you've got, core CPI run at 1.7%. Like the last 3 and 6 months. Okay. I mean, inflation is not really a problem when you take out shelter, which is, I don't want to get all in the weeds of it, but the way the government looks at it, it's just delayed. There are a lot of other parts of inflation that have come back. So again, the big worry though is, okay, let's say the Fed starts to cut. If I were going with this, if the Fed starts to cut, what if inflation comes roaring back? I mean, yeah, that's absolutely a potential worry out there. One of our big themes, and I'm sure I talked with you, last time I was on and maybe the time before, productivity in our country is running at some of the best levels it has since the mid-90s. 5 quarters in a row, we've had really good, strong productivity. Again, what does that tell us? Well, listen, when you have stronger productivity for an extended period of time, like we think we do, because we have people that are just today, we got the JOLTS data, right? People aren't really quitting jobs. Now, I know people aren't hiring either, but people aren't jumping around. So people are in these jobs for a long time, have an aging labor force. You're starting to see higher productivity. The mid to late 90s, we saw this higher productivity. Alan Greenspan talked about it way back in 95. You can go back and look this stuff up. He was in front of Congress talking about this. When you have higher productivity, you can cut interest rates. Maybe a good deal. You don't have to worry about inflation. And you know what also happens? You have wages that stay high and you put a cap on inflation. It's like this perfect elixir. I get it. To have all these things kind of working out. These are things we've been talking about in our shop for well over a year and a half now, that with the stronger productivity that's coming, that means you can start to cut a couple more times. And when you cut, that does grease the wheels for the economy. So that's kind of why we don't think, or why we're fine with the Fed cutting like they've done. Again, maybe we wish they would have done 25 the time before. Last comment on this, though, because they did that 50 basis points at the start, right? And everyone says, well, in 2000, I think it was 2000. But before the tech bubble, they cut 50 basis points first time, GFC 50 basis points in a 100-year pandemic. Okay, well, you start 50 basis points, maybe there's a monster under the bed. I'll give you that. But again, this time we don't think so because they probably should have cut before, and there are some differences. One final thing on this, though, there are 20 times the Fed cut interest rates within 2% of an all-time high. Remember, they just did that. They just cut with stocks within 2% all-time high. 20 times. A year later, S&P's higher. 20 times, about 14% on average. Just little nuggets, little things that, still, again, to us suggests this is not a 2007. This is not a 2000 scenario. Maybe more like a mid-90s scenario where stronger productivity, higher wages, inflation with the cap on it. Maybe you're going to start to see some bubblicious valuations. I'll give you that potentially, but earnings are still pretty darn strong, and we're not anywhere near the levels of valuations we saw in the late 90s.
So my answer to Bobby's question first. I think I like what you're saying, and I agree with the productivity part. We've talked about that as well, particularly with AI potentially being the next. Maybe
haven't even started yet. There's no AI in productivity yet. I mean,
I see, but it seems like it seems like there may be, like in a lot of the service industries too, lawyers, technology. I mean, whatchamacallit, the airlines, not the airlines. B of A just said they were letting 2,000 people go because AI is replacing their jobs. So I don't 100% agree with that.
Now. Yeah,
I think it's beginning to filter in. I also think that another element of the rate cut is I think the Federal Reserve is genuinely worried about the amount of debt service that the U.S. Treasury is going to have going forward. And they would love to see rates lower. As a matter of fact, I believe if the 10-year gets to be about 5%, that the Fed's going to step back in and start buying bonds again. And, every day I have the chart of their balance sheet up, one of the first charts I push up, and it's not going down the way it was before. So I think that's part of it too. Paradoxically, 2-year and 10-year yields have gone through the roof since they cut 50 basis points, but that's a totally different thing. But that's my answer to that. I did want to pivot over. There's an election next week, I'm told. I just heard about this today for the first time. So there could be different candidates with obviously, and we're not a political show at all. We don't talk politics. We talk a shit ton about policy because macroeconomic policies are important. And if everyone's like, oh, that's political, bullshit. It's not political. That's what we deal in, macroeconomic policies. Sure. One person has given tax reform that I personally feel is destructive. The other person's giving tax reform that might be inflationary. How do you analyze the outcome, and what differences does it imply?
Yeah, so a few things we knew coming into this year. First off, when you have a president up for re-election, and I get it, we don't anymore technically. I understand that, but we knew coming into this year, the last 10 times you had a president up for re-election, the S&P 500 was higher. So that's one thing to think about there. What do we know throughout history when it comes to Congress, right? If you have divided Congress, usually stock market does okay, right? We've got a 4-seat majority for the Republicans in the House and 51-49 Democrats in the Senate. It's widely assumed, people way smarter than me think that's probably going to flip-flop. Not by a lot, but you're going to flip-flop. So you're still going to have this divided Congress. Last 13 years, we've had a divided Congress. What happened? Stock market was higher. This is going to be the 14th year unless we have some really bad stuff take place here. So if we can still have that division, hate to say who's in the White House doesn't matter. And this is where I like to say I like to offend everyone. I'm an equal opportunity offender. Who do stocks do the best under? Yes, it is Democratic presidents historically. Now, there have been more Democratic presidents. Republicans kind of caught the grenade in 2000, 2008 being in office. I mean, that wouldn't have mattered who was in the office. Bad things were coming. But the flip side to that, when the Republicans control both chambers of Congress, stocks do a lot better. But again, when you have that split Congress, that's kind of the scenario that we think is there. And that's kind of what we think we are. I mean, this is a close race. We get it. You look at some Bitcoin. I mean, Bitcoin, I'm limited sort of, I can say with Bitcoin, but I saw 73,000, DTJ stocks, obviously, DJT stocks going up. So Trump's kind of pulling ahead a little bit here, it looks like. But the reality is going to be close. And we think if you have that divided Congress, that's kind of what matters more. In fact, it does matter more in our opinion. If there's an old joke, if the opposite of pro is con, then the opposite of progress must be Congress, right? I mean, that's an oldie but a goodie.
I still
there.
Love that one.
And never heard it before. I'm going to use that like I made it up.
Yeah, it's a good one. Just made it up. Anyway, no, but so that's kind of where we are. I mean, you're right. It is about if we see a major red wave, well, you're going to have a lot more tariffs, right? You're going to see tax cuts. If you have a big blue wave, you're going to have more taxes. Maybe not quite as many tariffs, but we don't think that's going to be the case. It'll be clear. I mean, that's kind of where we stand with some of that stuff. But I'll get myself in too much trouble talking.
No, it's fine. I got one quick follow up. Is that you mentioned Bitcoin? Yeah, Bobby and I apparently, we didn't know we were gold bugs, but we get accused of being gold bugs because about 2 years ago, we were saying, gold is the place to be. We have somewhat poor stewardship for our fiat currencies. So you have me at lack of confidence vote, and that's why I'm long both gold and Bitcoin. I assume, and this is an assumption, that your focus has been more about technology, just because I know you've been right about a lot of things and a lot of people have focused on technology. Is there anything in your calculus that's saying, okay, maybe we should flip from technology, start heading more towards small caps, or heading more towards dollar hedges like gold, silver, Bitcoin, real estate?
Well, great stuff there. So again, we manage money, so we've got models that are fairly diversified. I do want to be clear. We added a 3% gold sliver back in March of 23 in the tactical models we run. And it wasn't because we're big perma bears. I mean, I've been bullish for a while. We've been kind of one of the contrarian places saying, again, literally back in March of 23, 24, or 23, March, April, May of 23, saying, listen, we could be in a period where for years, stocks and gold can go up. Maybe by a lot, okay? So because there are certain things that are taking place right now. And everyone says, oh, my goodness, gold up, that has to be bad. No. I mean, there's a lot of times, just a couple decades ago, where we saw gold and stocks do just fine together, okay? Now, if crude oil goes up to 145 like it did, or where did it get, 150, 145 back like it did in 2007, 2008, that might worry me a little bit more. But with gold, we've thought that gold might do okay with some of the factors that are taking place right now. Now, Bitcoin is an interesting one because, again, we do have some Bitcoin ETFs on our platform. I kind of limited what I can say, but I do think it's kind of a liquidity thing. I mean, Bitcoin hitting all-time highs, it is what it is. Those high beta names tend to do better. Technology tends to do a little bit better. But we actually, with the models we run for the last, we'll call it year and a half, or at least the last year, we have had a slight overweight to small caps and a decent size overweight to mid caps. Mid caps have done fine. I get it. Small caps are so frustrating, but we do think we're going to get more of a normalized period. You look at valuations, right? Small caps are the cheapest they've been relative to large caps since 99. Kicked off a 12-year period of outperformance of small caps. Something's going to happen again, but that's out there. We also know earnings. Look at earnings. S&P 500 earnings next year maybe grow 13, 14%, kind of depending on your source. We think that's probably likely, maybe even a tad higher, honestly. The economy's going to do okay. Small caps are supposed to see a lot more earnings growth, okay? So again, we do like small and mid caps. We like this broadening out. What last thing on this, there's 11 S&P 500 sectors, okay? Every single one of them are up on the year. Every single one of them, I think maybe it's pulled back a little bit more, but at least as of Friday, every single one of them were up double digits on the year. Yes, people say, oh, this group, that group. Listen, that's how it works. Every year you're going to have some leaders and some laggers, but we really are seeing a lot of market breadth, a lot of participation. We think this broadening out theme, small caps, mid caps, which are cheap. We've loved industrials, financials. They've been our two favorite groups all year. Financials and industrials done pretty darn good last I checked. And we still think those areas should do pretty well going forward here.
So I did some of my own work on it became the gold and equities moving together thing, right? And it has a lot to do with a lot of the themes that you've already mentioned here. And you mentioned that the plane had plenty of fuel and didn't have to land, what some people are calling no landing, which to me means an overall reflation regime, right? Mm-hmm. Now, in fairness, I've stolen or co-opted the phrase reflation from Mike Singleton over at Invictus Research. And that to me means there's some equity sector back tests you can run that show stocks, energy stocks do well in reflation, not doing well right now. Tech does well in inflation, doing well right now. Industrials do well in reflationary regimes, not doing well right now. But I think the issue becomes, to me, and I want you to tell me I'm nuts, or maybe I'm not nuts.
Do that.
When you see equities
we can
and
stop
gold,
right there.
stop right there.
You don't need to talk anymore.
When you see gold and equities going up together, people have this false belief that gold is an inflation hedge. It's only an inflation hedge when the Fed is not fighting inflation. When the Fed starts fighting inflation, now the option to gold, which is higher yields, becomes a viable thing. Inflation drives asset inflation too, which means stocks, homes, gold. So inflation is good for stocks in the research I've done. Yeah. I worry that the Fed is about to realize that the economy is as strong as you and I seem to believe, and that they're actually juicing it up a little bit or just enough to worry the inflation bugs like myself. So people say, when are you going to get out of that gold call that Jimmy and I both made in late 2022, right? I'm not. Yeah. I don't see anything happening. So what's going to crack first, gold or stocks in your view? Or can it keep going like this until the Fed realizes they might need to hike again?
Yeah, good stuff there. I think it can continue. I think both. I mean, literally, like as we sit here, like both are like at all-time highs, right? I'm not smart enough to know when they're going to stop going up. Learned that a long time ago. You could argue maybe the hard way. Learned that a long time ago. With gold at least. I mean, well, back to kind of the original, or not the original. One of the questions earlier about the election. What do we know that's maybe whoever wins, what's going to happen? Well, listen. A lot of deficits and a lot of spending. I think both presidents have proven they don't have a big problem with that. So again, those types of things potentially can pressure the U.S. dollar lower. A lower dollar historically is pretty good for commodities, pretty good for materials, pretty good for gold. Like we said, one of the reasons I also liked gold in early 23 when we kind of made our call on that, the first 10 months of 22, what happened, right? Well, stocks and bonds are like their worst 10-month period ever, okay? But the U.S. dollar was really strong. Gold did okay in 22, didn't do wonderfully, but did way better than everything else. With the dollar up as much as it was, I was really impressed with gold hanging in there like it did. And then sure enough, now it's kind of unwound and made new, what was it, 27, 2800, whatever gold is right now, unwound and has gone higher. So I think it really makes sense. You can have both. And that's a great point. About actually, I don't know what I was going to say. You said something about the dollar and gold. The gold. Inflation. Sorry.
If the Fed isn't fighting inflation, then asset prices rise along with the price of eggs and the price of rent, and asset prices rise.
Mm-hmm. Yeah, and again, that's what's so neat about. Well, I'll do two things. Maybe I'll answer my thing about gold inflation. You're exactly right. I mean, gold has done really well the last couple of years, and honestly, I get where inflation was, and you see the year numbers. But honestly, inflation, there's a lot of prices that have come back. Okay, maybe they're still up year over year, but they're not nearly up as much as they were. So inflation back in early 22, the first 6 months of 22, gold didn't even do that much. That's when inflation really soared. We had a war break out in Europe, one of the biggest wars since World War II break out in the continent of Europe. Yet gold really didn't soar then, but it's soaring now. So it's not necessarily an inflation hedge. I guess you could say maybe it's a disaster hedge to a degree. At the same time, what did gold do, right? In 1999 at bottom, I think with $260 an ounce, somewhere around there, went straight up for 12 years. And then for about 12 more years, just went sideways. I mean, sideways is a strong way to put it, but kind of that nice cup and handle. So I'm a big cycles guy. And then I'm like, okay, maybe it's got another 12-year period going higher. It's been going higher for a while now. There could be many more years left of those high entire assets. And what's unique about gold is, then you look at silver. Silver is more of an industrial metal, but obviously that just broke out, right? That just broke out not that long ago, last week, I think, right? Yeah. So maybe there's some other areas that start to play catch up when you look at these precious metals. And again, it doesn't mean stocks can't do okay, because we've seen periods in time where they all do pretty well for a long time, and we again think we're in one of those areas.
So Ryan, I'm going to ask Jimmy this question because it's going to be part political, and you can feel free to chime in if you'd like. But Jimmy, I mentioned to a friend of mine today when we were talking that, as Ryan mentioned, it looked like Trump is leading. And this particular show is going to come out as they're counting, right? We'll have an idea of what's happening, but then the other votes will be counted and it could be completely different. So how do you square this particular circle? Trump is a low rates guy. So if he wins, right? And if Ryan and I, and to a certain degree, you are correct that the economy is doing well and is likely to do better, and there's a lot of ifs in here, if Trump wins and if the Fed then realizes, well, maybe things are starting to head up toward 30,000 feet again, we've got to kind of get this thing back down to kind of cruising altitude at 20,000, and they start to hike rates. How do you think Trump will react to that? Do you think he'll do this thing where he's like, I just got elected, now the Fed wants to screw me?
So here's an assumption that everybody's making that I'm not sure is completely fair. Okay. Trump was a low rates guy, big spender. I love deficits. I love debt. Okay. The backdrop of that time period was deflation or disinflation at the beginning was slightly more of a worry than inflation. And at the end of his term, deflation was a massive worry when we were going to, start to
pre-COVID.
As COVID was, the lockdowns were happening. So the question really is Trump so much of an idiot that he can't, and I'm not trying to be funny, that he can't adapt to a new set of circumstances in which inflation could be a problem? And I think the answer to that is maybe, because an idiot might be too strong a word, but myopic in what he wants. And I think, could he focus just on, like we talked about, the fact that inflation is 2.5% right now too, which I basically think is the Fed's real target, even though they don't say it. But the end of my stories too, and I'm interested to get Ryan's opinion on this too. I think at the end of the day, how do I say, the Biden administration, inflation was already raging, and they passed 3 of the biggest spending packages too that were inflationary. To me, it was just malfeasance. It almost seemed like they didn't give two shits.
One was called the Inflation Reduction Act.
One was called the Inflation Reduction Act, which makes me want to. But anyway, I think they've proven that they spend in inflationary regimes. Trump still, I'm holding out hope that he's smart enough to know that you can't just pop the cork on the champagne bottle and let everything run when we're running at 2.5 to, let's say, 2.7%. Am I too optimistic, Ryan?
Well, I think it kind of goes back to what I was answering earlier. If we get that division, it's going to be really hard
to do anything.
Yeah. I mean, in 2016, the election, 2017, right? It was a red wave, right? Republicans control into Congress, and the stocks did just fine. But then in 2018, what happened, right? The trade war happened. We had a new Fed chairperson, right? A funny little Jeopardy stat for you. It was February 4th of 2018. That was one of the Dow dropped 4.6%. Okay, that's when the trade war started. That day they slapped it on washing machines, I believe what it was. But that was Jerome Powell's first day. You go back in, that's like the worst first day anyone can ever have on a job. You start, the Dow drops 4.6%, the trade war starts. Welcome to the Fed, Jerome Powell. But we've seen that historically when new Fed chairpersons start. You can get some indecision. The market's kind of working that new, like early in a boxing fight, right? You kind of throw some punches, get the use to somebody. So one of the greatest handoffs in the history of mankind was in August of 87 when Volcker said, all right, I'm out. Greenspan, you're up. I mean, we gained 500% in the S&P the last 5 years. He probably knew that was a stretch rubber band. He said, take over. And then boom, we had 87 crash. But what I'm getting at, there's going to, of course, we know Trump is Trump, right? There's going to be pressure. He's going to be yelling at the Fed about different things. I think in 2026, that's when the term, I guess the word is, the term is up, right, for the current Fed chairperson. He's probably out. That's a midterm year also. Midterm years usually aren't that great for stocks. When you have a new Fed chairperson, stocks can be a little dicey. We're pretty optimistic next year, 2025 is still going to be pretty good. A honeymoon season. Whoever wins the election, first year is usually pretty good. Once you get to that second year, you start to hit some indecision, some problems, and maybe that's when we start to get a good deal more cautious. But the reality, again, if we have a split Congress, maybe all this is mute because it's going to be hard to get anything done. And last thing, I agree 100%, not 100. I should never get 100. I live in a world where I can't make guarantees, but I agree a lot that the Inflation Reduction Act was not about reducing inflation. If you peel back the onion, it was about EVs, it was about batteries, it was about a lot of things. Look, I live in Ohio, right outside of Columbus. We're building an incredible, huge facility to make these high batteries and EVs and chips. Those are onshoring, right? We talked about manufacturing, a while ago. Do you look at what's going on? High tech equipment manufacturing is soaring in this company because we're bringing it back, right? The CHIPS Act, certain things. I mean, the government, everybody knocks the government for what they spend money on. I do as well. But I think the CHIPS Act and honestly the Inflation Reduction Act, even though it wasn't about reducing inflation, they're bringing EVs and batteries and doing this stuff here because we realize when China's on lockdown, shutdown, and we want our chips, we want them now. Let's make it on our own. Maybe it's going to cost a little bit more because we're making it here on our soil. But if we have another 100-year pandemic, let's hope we don't. If we have any other issues in other countries, we control it. We do it here now. So that's one thing that we've been talking about for a while, that we are seeing real manufacturing, explosion of manufacturing productivity, or manufacturing construction. Now, as we move forward, we built all these big places to build this stuff. Now it's got to it's kind of the time to show up now and start to make these things. And that should, again, help this productivity story that we talked about a little bit ago.
Two things. First, a comment. And by the way, I bash corporatism and the government getting involved in it.
No, we bash it. Exactly.
No, but I was going to say that is completely unrelated to the fact that oftentimes they can hit a home run with their involvement. That's not, the two things aren't like, I'm not hypocritical. It's no big gotcha aha moment for anyone who's calling me on it. I think the CHIPS Act is doing some very, very interesting things. I have two brothers in the chip industry. I think they would say the same thing. Yeah. Now, my question to you, and I spoke at a chip convention. I love speaking out of industry, by the way. I don't know if you guys ever do too, but I spoke at a chip convention down in Miami last winter, sponsored by Avnet, and it was quite a bit of fun just hearing all them talk about their business, and I just talked about macroeconomics. But back to markets. Yep. We all seem to like stuff, and I think at the end of the day, we are saying that there's going to be government spending. Being just in dollars might be the wrong place to be, so stuff that's denominated in dollars does better. When you look across the spectrum, is there any place within the equity market sectors that you say, no, that would be dead money?
Mm-hmm. Yeah, what's unique about it, and I'm sure you've talked about this, when we've had previous elections, and hold on, in 2016, right? They said Trump doesn't like Jeff Bezos, tech's going to do terrible. The first couple of months in November, December 2016, we all remember the market rallied, right? On that night, futures crashed. Then the market, tech did not do very well. They said that, energy would do great. They said financials would do great. Green energy do poorly, but the exact opposite happened. Fast forward 4 more years, where are we? The top group under President Biden is energy, right? When he took office, they said he was going to go after coal.
I bought it the day he won the election. I bought energy because I thought,
there you go. And, and remember, energy went to zero, and I know that was, the pandemic and things, but honestly, so it's not so clear cut. I just want to be not so clear cut. But to us, as we look forward, I kind of talked about it. I mean, large cap tech, we are neutral technology. I'm not saying we don't like technology. When you manage money, sometimes you kind of have to say, I have to have some technology exposure, because if we're wrong, that's called career risk, right? But again, big picture, who was it? Goldman Sachs just came out with that 3%, S&P target the next 10 years. I think it's a little higher than that, but again, look at what they really said. They said, listen, maybe large cap area doesn't do as well, but there are other areas that can do well. I mean, from 2000 to 2010, let's call that decade, right? We know the stock market didn't do well, right? That was the worst decade ever, the worst in the 30s. We saw 250% crashes. But last I checked, value did pretty well. Small cap did all right. Commodities obviously did extremely well. So there are other areas, and I think that kind of makes sense that there's going to be some other areas, small, mid caps, we like those a lot, let's say, the next decade plus, because I don't know if large cap's going to lead the next decade. I don't think it will. I mean, anything can happen, but I think there's some other areas that are going to do pretty well right now.
So I want to talk about, again, this is going to be coming out right around when the elections. I don't know if we'll know. I don't know if we'll know for 3 weeks when the election is.
Didn't last time, right?
Florida, where I live, promises the official announcement by like 9 o'clock or 10 o'clock the same night.
Yeah.
I believe Tennessee's the same way. Kentucky's the same way. Carolina's both the same way.
All the states that don't matter
Yeah, Michigan
No,
said
no,
it
I mean
might,
they matter. I mean they matter, but
Right.
we know which way they're going to vote.
yeah,
There's
but Michigan
6 states we need to know, right?
Michigan said it might be 3 weeks.
Exactly.
I
Yeah.
don't understand 3 weeks. I just don't. But
Mm.
when we're looking at the two potential administrations, we're looking at both having been spenders, right? We know that. We know that the Biden administration, which by proxy is the Harris administration, spent more if you take the pandemic out. So, but Trump was still on a trajectory of having a higher debt to GDP ratio. He also mentioned a bunch of times of why don't we just issue new debt at the low rates we're at now, pay off all the old debt, and then keep it at lower levels, right? Is that legitimate, and what would that do with the equity markets? And then I have a second question: if that kind of thing happened, we had got an idea from Steph Pomboy at Macro Mavens. She mentioned it on our show. She mentioned it on Fox News as well, as a way to kind of short-term help the U.S. Treasury of making U.S. Treasuries tax-free to American citizens. Actually, let's go backwards on those. What do you think of that idea? Because I love it, but also I've heard people say it would crush muni bonds, could hurt stocks on a TINA basis. What do you think about that idea?
Yeah, I mean, I have to think a minute here on it. I mean, it's very unique and interesting. What I will say, though, so that's the government debt, right? I mean, I'm
Right.
not a fan of 36 trillion. What's the latest number? 37 trillion?
It's a lot of trillion.
Yeah, a lot of trillions there. A lot of companies did exactly what you just said. I mean, Microsoft, Google, all those big ones. Because one of the bigger surprises, at least to me, was in 2013 when we did see yields go higher, right? What happened? Yields went higher. Yet tech was like the best group. Remember, everybody told us for a while there, oh, interest rates go up, that's bad for technology. Yields go up, bad for technology. I think one of the big reasons why, because they did finance a lot of debt at historically low levels. All of a sudden, next thing you know, yields are up here. You can take that cash, put it in the money market, make 5%. Maybe it was dumb luck. Maybe it wasn't. So that's his big difference. I get to present all around the country, and everyone's worried about the government debt. And I get it. There's a lot of government debt. But if you look at balance sheets of corporate America right now, they're in really good shape. Look at balance sheets. We like to look at this stuff with house. This is all free data you can get on the St. Louis Fed's website. We look at what's a balance sheet, right? Assets and liabilities. If you look at assets and liabilities on households, but then you have to normalize it by something. You can't just say, well, it's the same as 20 years ago. It wasn't. We normalize it by disposable income. Guys, if you do that, household balance sheets right now are in the best shape they've been in 25 years.
Yeah.
People are worth a lot more. There's $1 trillion in credit card debt. How many times do we hear that? Yes, that's a lot, okay? But they don't tell you how much disposable income. That's only like 6% of disposable income, okay? What in the world does that mean?
Point, it's actually at like the lowest level since 2014. Credit card debt
and
as
it was
a
like
percentage
8% before the
of disposable
GFC.
income.
If you look at credit card debt relative to disposable income, so it's kind of this hodgepodge way of looking at it. But there really are corporate balance sheets and household balance sheets are in great shape, really, really good shape. To me, as an investor, for the next 12 months, 18 months, if you're more of that's your time frame, I'd rather see that in good shape than the government. I'm not a fan of all the government debt, and yeah, we've got some problems going on, but last I checked, every time you have a crisis, the dollar goes up. Until that stops, okay, we do have the world's reserve currency. When you have the world's reserve currency, can you play by a different set of rules? I'm not crazy about it. Maybe you can. And one of the big things remember early August, I know everybody does, the yen carry trade unwind for a couple days. Everything's crazy. There's red all over the place. Everybody's freaking out. Yet the dollar went lower. The strongest currencies during that 3-day crisis was the Mexican peso. We're looking at our teams looking at each other like, what in the world's going on? This is truly this big deal, this yen carry trend unwind. Everyone told us it was. The dollar would be getting more of a bid. And we said, this is not that big a deal. We had 8% pullback. Dollar told us there was no risk going on. And then the market obviously did what it did. And we actually finished higher the month of August, which is wild when you look at how you start. But the reality, again, the dollar is still the world's reserve currency. So maybe you can play a different set of rules.
So can I chime into that too? Because I agree that you can play with a different set of rules, and we are playing with a different set of rules, being the arbiter of the world's trade and having the reserve currency status. I believe you can only do that for a set period of time, but that period of time is way, way longer than anyone anticipates. And I'm hoping that cooler heads will prevail. But I mean, we are definitely, in my mind, heading towards a bad spot from debt. I don't think that that's even very, very radical to say. I'm hoping that if like, let's say an Elon Musk comes in and he's really, by the way, did you guys realize that he's supposed to be the Department of Government Efficiency, which, by the way, you know what the acronym is, correct? Doge. Did you guys get that yet or no?
That's true. Yeah, good point. Yep.
No, you guys did, because someone said that to me
Nope.
today,
Right.
and I was like, oh shit, because he loves those kind of things. You know what I mean? He does that all the time, which I think is hysterical if it's the case. But if they really do cut government spending, which by the way, I'm for cutting government spending almost to the bone, but you can't do it all at once. It needs to be very, very gradual because markets get disrupted quickly. My big tell, I think I said before, the Fed's balance sheet, because I believe the Fed is going to come in and buy bonds. And I think that could hasten the problems we have. And I don't think they should, by the way. I don't think they should be facilitating profligate spending by the federal government, but I do think they will. At that point in time, if the Fed comes in and starts buying bonds, would you, in any of your models, switch rapidly to more dollar hedges than traditional equity exposure?
Yeah, I don't think I do it very quickly. We want to see some of the reaction, but I'm with you that on the surface would make me a little nervous. I mean, I guess, the thing I've always said I like to follow, there are two things I like to follow, because these are all like hypotheticals and very important questions we should be asking ourselves. But I like to look at, what are credit spreads doing, right? You look at corporate triple B spreads, investment grade corporate spreads. We are still seeing very little stress in the credit markets. If something like that were to happen, I bet the market would sniff it out. Like in 2007, we saw credit spreads looking back. I mean, a lot of people miss this, but including myself, credit spreads were blowing out most of 2007, telling us there's some big monster under the bed. Who knows what it's going to be? We're simply not seeing that yet. And then advanced decline lines, how many stocks go up versus down? Just last week, small caps, mid caps, Dow, S&P 600, S&P 400, NASDAQ, maybe not NASDAQ, but all these other ones hit all-time highs. So there is still a lot of participation. We start to see breakdowns there and stress in the credit markets, and then some of these things we're talking about. That would definitely worry me and maybe take us off of our overweight in equities that we've had for a long time. But again, this is why you have a diversified portfolio. Back to kind of my world, right? As someone who manages money, this is why you have a little bit of gold, you have a little bit of bonds in there, you have some utilities. I mean, if the what hits the fan and something bad happens, this is those other areas. Now, again, we're underweight. Rest of the world, developed international, EM, we're more even weight developed international, more underweight emerging markets. But some of those areas might do better than the U.S. if this is where some of the trouble truly starts with the U.S. So the last I checked, there's a lot of debt issues over in Europe as well. So that's not such a perfect area, but that's again why you kind of diversify to help you sleep at night. It's kind of cliche to say, but kind of how we look at it.
I like it. But we're investors too, but we're traders. Sure. We want to make money now, today. But Bobby, this question is for you as well, because I still do think, to Ryan's point, credit spreads are one of the biggest and earliest tells of real life stress that can develop into something somewhat onerous. However, there is part of my brain that says credit spreads also reflect the undeniable fact that we've entered into a bailout nation sort of world. Yeah. And I do sometimes wonder, I see you shaking your head, that's an okay point, right? Is what you're saying, I think? Yeah. Oh, no, so Bobby, right. Do you think there's validity in that?
I do. I'm looking at it a little bit differently, but although I'm still including credit spreads, consumer defensive stocks are doing well, but they're underperforming the S&P by a lot.
Yep.
And so I think if consumer defensive started to become the leader, you might see that stress in credit spreads widen out. And it doesn't have to widen out to where it was before. Past performance is not indicative of future results. I think we definitely live in sort of a bailout nation, but I think there would be a little bit more credit stress if there was actually an issue in the economy and if we had Trump as president, because in theory, he may not bail out certain industries. He may not. We don't really know.
Ones he doesn't like, and ones that have ever said anything bad about him don't get bailed out.
I do think it's valid, but it reminds me of the whole thing with the VIX. The more that people realize that a spike in the VIX is probably a buy signal, the lower the VIX tends to spike in emergencies until that one spike comes.
When it's 50, right?
Yeah, the one that goes up to 50 or 60 or 70, then everybody gets all nervous and reverts back to that lizard brain stage.
Yeah, but I had the TMZ of financial networks on, and Jeff Kilberg, who's our good buddy, but I've never heard him say anything smart. I'm just kidding, Jeff. You say some smart things all the time. But I heard him say what I thought was the most brilliant thing. He said, when the VIX gets over 45 and 50, I close my eyes and I buy stocks. And I was like, you know what? I guarantee you, I don't even have to look at historical data. I guarantee you that that's a good buy. Do you like that strategy, Ryan?
No, I do. I mean, honestly, in August when we had the big sell-off and we saw the VIX spike, pretty significantly. But what was so unique about it, we saw the VIX implode in like I don't know the exact numbers off the top of my head, but we had a high VIX. Within 2 or 3 days, we saw the VIX down like 10, 15 points on a closing basis, okay?
Yeah.
And I went back and looked, and that's the worst is over, right? The VIX is that tell. Yeah, we get more freakouts with the VIX when it goes higher, but once it goes lower, and I agree with Jeff there, and in general, when you get that VIX spike, especially in bullish trends, if the S&P is above the 200-day moving average and you get this big VIX spike, you know what? That's probably just one of those freakouts that happen. I mean, it's crazy this year. The worst pullback we've seen all year is 8%, right? Your average year sees a 14% correction. You tend to see, 3 or 4, 5%ers a year. You see on average a 10% per year. We haven't even seen that yet. I don't think we're going to. I'll be very clear. I don't think we're going to this year. So that's just kind of something to think about. Maybe next year we maybe do get a well-deserved 10% peak to trough correction, because it usually happens most years. But we've been fortunate haven't had one. I haven't had one this year so far.
So quick question. This will be my last question, Bobby. Then you can ask the last question, and then I'll carry us out. But we mentioned credit spreads, both of us. What do you have up that shows you credit spreads? Is it just HYG or JNK, or is there a better barometer? The CME has a futures contract that measures credit spreads. I don't know how liquid it is yet. Where do you just have a guy who says, "Hey, credit spreads are blowing out," and then you're like, "Oh shit"?
Oh no, I mean, well, great question there. I mean, I track them, right? I mean, you can go to St. Louis Fed for free, and you can do the triple B spread and the OAS spreads.
And is it updated during the day too?
Oh, it is end of the day. I don't look at during the day. I mean, maybe I guess I would like in August. The last time I looked intraday was like early August. I'm too busy talking to people doing things, so I don't look that closely. Maybe every day, at the end of the day I'll look, or maybe the next day I'll look. But I just know if the market's fairly calm, or I'll hear about it from somebody as well. But for the most part, I don't look that closely at it.
Bobby, what do you got?
Yeah, I use St. Louis Fed, same thing. And I look at the end of the day. But it's one of the things I keep track of along with the yield curve is those two things. Yeah. So in terms of like coming in toward the end here, the inflationary debate between the two candidates, I'm not going to ask you which one is more inflationary, but I am going to ask you about a specific policy in case it comes to pass when people are watching this. $25,000 for new home buyers, $6,000 in extra child tax credits, and I think it's $50,000 to start new businesses. Inflationary, good idea. What do you personally think? This is not Carson Group. This is you. Yeah. And I'm not asking you to pick a candidate by any stretch.
Mm-hmm. Yeah, I mean, listen, anytime you do spending like that, it potentially is inflationary. I think it's kind of the way to put it here. But is inflation by itself bad? I mean, listen, long-term inflation's average like 4.5% a year. We're lower than that now, so maybe with either candidate, honestly, could be. I mean, honestly, Trump, if he wants to do some more tariffs, at least by the book, they tell us tariffs are a little bit more inflationary. I'm not so sure I believe that, because I didn't really see much inflation. Yeah, I didn't see too much inflation in 2018 and 2019. It took a 100-year pandemic before I saw that inflation, but that's what people on TV keep telling us about. But the reality again is we could see a little bit more. At the same time, I mean, there's just been so much wealth that's been created. I'm not trying to ignore what's happening out there, but again, people are still spending, still in pretty good shape. Maybe we, after the gains we've seen. I mean, this is one thing I didn't talk about this, and I'll kind of spin it like this. So this is the third year of a new bull market. All right, we just had the second, I call it birthday. Some people call it anniversaries. I call it birthday. When I went back 50 years, when you have a bull market, make it to the third year, like this one just did a couple weeks ago. There's been 5 of them, okay, 5 bull markets. The average one of them made it to 8 years with a 288% average return. This bull market is 2 years old and it's up 62%. So anything can happen. I think it's just important to know that these cycles, I say it's like a cruise ship. Once you get moving, you really move. Or look at the data with people. You get to 65 years old, you know what happens? Your odds of making it to 85 go astronomically higher. So I think it's just really important to remember these cycles can last longer. Now, something for everyone, last thing here, third years of bull markets usually aren't that great. Why is that? Because years 1 and 2 are usually really good. We gained 21% the first year of this bull market, 34% or 32%. The second year of this bull market, like the best second year ever for a bull market. Maybe the third year is kind of choppy. Maybe potentially it is a little aggravating. I think we still can hit low. If I come back in a year, I wouldn't be shocked if we had low double-digit gains. But, again, not quite the spectacular gains that we've seen, with a little more volatility. But years 4 and 5 of bull markets actually do really, really well. So I think it's just really important to kind of remember some of these concepts when you get those scary days, you get those those red days. You see all the headlines and things that happen. We might see really soon next week with this election and the uncertainty around the election. But the reality again is there's still a lot of fuel in the airplane, as they say. We don't see any need for a landing, and this cruise ship is moving, and this bull market's still alive and well, in our opinion.
You know, in the NFL, I always thought the quarterback gets way too much credit and way too much blame for the ultimate record of the team, right? Mm-hmm. And I think it's the same thing for the president, the executive office, in terms of the economy. But what I will say off of what you just said about a 8-year average bull markets, former President Trump inherited about a 7.5, 8-year-old bull market. And through tax cuts and deregulation, in my opinion, extended it to the longest bull market in history. Mm-hmm. I'm very curious, and this is not, you don't have to answer this, just a general statement. I'm very curious how he acts if he were to win, inheriting a 3.5-year-old bull market. Does he spike inflation, or was he just the right president at the right time to keep an old bull market and sort of extend its life? That's sort of my last comment. And if you guys have comments, feel free.
Well, it took a 100-year pandemic to kill that bull market, and it happened. I mean, it obviously happened. But I'm with you. That cycle could have continued to go a little bit more. But yeah, a lot of this is, at the end of the day, kind of put it this way: don't base too much on politics. Don't let politics get into your investing. I can do this for a living, talk to people. You guys do too. So many people like, oh, I hate her. I hate him. If so-and-so happens, I'm going to sell. I'm going to do this. You know, under Trump, obviously, the stocks did well. Under Biden, stocks did really well. Not the first year, but the second and third year. And then go back and look at President Obama. Stocks did really well under him as well. So I don't know whoever the next president's going to be. I wouldn't be shocked at all if we look back in 4 years. You know what? Maybe I didn't like him, but you know what? My portfolio's up. I think that's just kind of how I still see it playing out.
So he is Ryan Detrick, the chief market strategist for the Carson Group. Tell them where they can find you, Ryan.
Yeah, again, at Ryan Detrick on Twitter. carsongroup.com/research is our blog. And then Facts versus Feelings, or type my name in wherever you get your favorite podcast. That's a weekly podcast I do talking about.
By the way, I love that name.
We're talking about now.
Yeah, I love Facts versus Feeling. That's a great name for a podcast. I appreciate that very much.
Thank you.
I am Jim Muriel. That's Bob Iacchino. This is the Futures Edge podcast. Couple housekeeping items. Please go to the website of one of our favorite sponsors, Hardcore Italians. It is the Christmas season. There is no better gift for the Italian on your list than one of these hysterical t-shirts.